Welcome viewers to another one-to-one Mining Investment America's online session. I'm joined here today by Michael Danov, who is the Chief Investment Officer and President at SBP Investments. We're going to be taking a view from a family office on what's going on in the mining space and where the sentiment lies for exposure to mining companies, in particular gold, precious metals companies. Michael's President and Chief Investment Officer at SBP Management, as I mentioned, a family office that specializes in the mining, healthcare, natural resources, and technology space. And I'll leave it to Michael just to tell us very quickly about their special areas of focus, and then we can get into some discussion around investing in mining. So, Michael, welcome, and please give us a quick run through.
Sure. Thank you, Adam. Thanks for having me today. So as mentioned, we're a single family based in New York. Our primary focus has been investing in natural resources up until 2013, then diversified in 2017 into healthcare, tech, and other investments, so becoming more of a generalist. We're looking for high growth companies between public and private. Ideally, something that's undervalued. We focus on smaller cap companies, growth stage, great management that's been supported for over the years, and as well as with those small alternative investments. We typically have 1 or 3 horizon view on each investment, sometimes 4, but we like to monetize our investments and have a specific rate of return that we look at each one of them. And in the mining space specifically, I personally came from sell side to buy side now, so I used to cover all the top 100 mining companies and obviously switched to the buy side. And it's a long-term relationship. There's multiple cycles where you could see the upside and downside, but by the end of the day, we were looking for growth and stories with excellent senior management track record.
Okay, well, let's dig a little deeper into some of those criteria for you and how you're looking at investments. But first, let's focus on precious metals and the gold price, obviously that's performing very well. How do you see that story unfolding towards the end of this year? And is that something that you as a family office watch very closely in terms of making your investment decisions, or is it a corollary to a whole manner of other factors involved?
Sure. So there's kind of 2-3 ways how we look at it, the gold price itself and the way it stands, right? So we look at the sort of the fiscal, the monetary, and as well as the debt side of the whole kind of world and each country's where they stand. So not looking at the operational side of the gold industry at first, we look at the more of a general macro view of the gold price and where it is, where it should be. I think we have priced in the gold price where we think it is today. It's around kind of 2,100. I don't know. It depends what U.S. post-election will be and how we'll go further out there. But it so far has, with the amount of money is being printed in U.S., and I think there's going to be not just U.S. and the rest of the world, of course, during the pandemic time, we think there'll be a higher rise in the gold price. But at the same time, we know the reality. We know how the gold price is monetized in the sense where the way it's priced in and how it's traded among the other ETFs and platforms. So we are comfortable enough where it is right now. If it hits our target rate, it's great, but it's only hopefully with that target rate, it'll give an uptick to our share price of some of the companies. Now, if we're looking on the gold price outside of the macro view, more on the general view compared to supply demand, I think gold price should be even more higher because there's no mines have been large enough to go into production to support the current supply versus demand. So I think that's going to take more time to price in, but I don't think it will get there until investors realize what the supply demand really is and how much old mines are coming off into production, lower grades, and it's not really getting fixed in. So I don't think it has hit the reality, but at the same time, I think that will be a big factor as we go forward.
Okay, plenty of room, bandwidth for growth there. Okay, so let's focus now on gold mining equities. You think this is a great time for gold mining equities, and how do you look at gold mining equities in the face of ETFs or physical gold, for instance? How would you balance a portfolio for your family office clients there?
Sure. So we strictly go to equities. We don't do ETFs.
because as mentioned in my earlier call, I recall that I used to cover a lot of these companies on the sell side, so I built a long-term relationship with a lot of CEOs, CFOs, and chairmen of these specific companies that we have positioned, held, and before, and still hold. We're all about believing the management. We believe supporting specific equity. We don't mind sitting on it for 3 years if we see the value and the compound growth is there. I think what happened now in the last 2-3 years, we identified specific group of companies. I would say maybe 40 to 50 names, and narrowed down to 10, 15. That doesn't mean the other 30s are not fitting our model yet, but at some point, I think we're gonna start paying attention as they grow. So they're on our backbone stores. So we look at certain stores who could be an M&A, and when that happens, we want to recycle that capital into those names that we monitor. So we love 15, 20 names. We have, I would say, close to around 10 positions right now, give or take at any given time. And we don't see a need personally to go ETFs or into physical because of our understanding. As a hedge wise, we look from a different avenues how to hedge those positions. But if we were not family that it has the background operational and as well as the experience, we would want to hedge a little bit more if we were just starting out to invest, let's say, today or 2 years. But since we've been involved over 10 years, I think I have great knowledge and just the resources out there that provides us the hope, and that we believe we are straight equity investors.
Yeah, absolutely. Okay, so within that, within the companies that you look at, then your holdings, are you more weighted towards the junior end? Do you see that as where the value and appreciation is going to happen? And how do you view mid tiers and majors as well?
Sure. So traditionally, when I started out in this industry, I would probably look towards junior because this is kind of high risk, high reward. Like if you look at it, a biotech company investment as well, it correlates very closely. And then assumption, a lot of the juniors don't translate to producers that get bought out by mid-tiers or majors, and very few times a lot of the juniors that are run by the management have the expertise to take into production. It's a different level of business. What we've noticed from rate of return in the last, I would say, 3 years, predominantly, we've seen better results on a long-term basis. If I held a position for, let's say, 2 years straight without trading it, we've seen a better return and less volatility on mid-tier and producers because of restructuring of the debt, becoming cash flow positive, unloading certain assets, and that has been rewarded to those specific mid-tier and larger producers. Now, on the junior side, the only way we look at today is if it's a spin out from a particular major who doesn't have a focus for one of the reasons is to fit their plan. If this is not a $5-10 million ounce producer, it could be only out, but like let's say between 1 and 4. We've seen high grade assets got spun out like that, and they're getting still good recognition because whoever the owner was still holds a majority position. It's very easy to verify that this asset can scale, and this could be a bought. But otherwise, the only juniors that we've looked is the ones that we knew in the past who had a good run in the early, I would say 20 of the 10s, and they did not sell. They lived through the cycle, they waited it out, and now they're coming back. And again, it's a very handful that I could say. I can't speak more than 5 names. I think from our capital perspective, we got much better return with mid-tier producers and general larger producers overall.
Yep, certainly. But that's the story so far. Do you see that changing, or sort of juniors coming more into favor right now, especially with a gold bull market? And within that, how do you distinguish the good companies from the bad companies? A lot of gold companies are going to be wanting to raise now. There's a lot of intriguing stories out there because of the prevailing market conditions. How do you work out who to meet with, who to do deals with?
Yeah. So we've met few of the it's a question comes down: are these the juniors been around for the 10 years and haven't provided any upside to investors and they just drag the companies along to survive through, or are these the juniors that are actually advanced stage now? Kind of, are they in a phase going to be sold, bought or sold, or are they going to take this to a production level, bring in a new management to take it? So I personally haven't seen too many in that category. And I haven't also seen new names, maybe just 2-3 new names that I learned in the past maybe 6 months that really did well because of the uptake in the gold price and because it spun out and they got quite a bit of capital and they got a good support. But I still see even volatility in those share prices. So it's a more of a short-term return. I don't think it's a long-term gain where I could sit for, let's say, 2-3 years and be comfortable and not worried about it, because we've seen the share price go from 80 cents to $1.50, now back to 90 in the span of 3 months. So if I'm playing in a short-term game and I'm trying to capture the momentum, maybe just play a bit. But again, I don't think it's something we've been comfortable and still analyze. And it's very easy to vet today. To your question is, who are the juniors out there that's going to get to what we're looking for? And we just narrow down search very quickly. If it's the same founders still selling the same story from 10 years ago, we're not going to be touching those names.
Yep, certainly. What about the sort of jurisdictions then that you tend to find these better companies in, or are you more favorable to a certain exchange, for instance, where you feel that the mining companies are performing better, they are ticking those boxes for you?
Sure. So I have a couple of views on that and what we've done. So recently we've been exposed to West Africa. Something I haven't done in the past at all. It's by meeting specific 2 companies that we built a relationship the last 3 years, understanding and why they're getting mispriced compared to some of the mid-tier producers in US or Canada per se. And that paid off quite well. So we bought them very cheap and done very well. And they got fully priced in after 2-3 years. And I think that was majority by institutions coming out of Europe supporting them, than North America. Now, in terms of exchanges, and I mean, other jurisdictions that we're comfortable investing, to your question, is obviously North America. We've occasionally look at South America. I mean, we love Mexico. We have no issue there. We have 2 positions there, and then they've done well. Peru, Chile, Brazil, it depends, right? Where we look at, for example, those countries. But majority are still North American and Canadian assets. In terms of exchanges, so this is something I've been battling with a lot of Canadian companies, even mid-tier producers, who are only traded on TSX, and they can't get the high valuation compared to their peers who trade in New York Stock Exchange. So we are big believers that if you have a dual listing with US as your primary and your secondary, let's say TSX or LSE, you will get a much greater of return on your investment and other investors who are currently in there. You start with index funds, you start with larger pool of capital. So I would say 8 out of 10 companies today are listed in US, and that's where the primary exchanges are. So we are a big support of that. We would not have, we've looked a bit in the Australian exchange. We don't believe that's the exchange that will create us the value. We have a sort of priority as New York, with it New York Stock Exchange and NASDAQ, then it's TSX, the main board, and London as the last as well. And that's kind of where and then a question comes in, where's the most liquidity in the stock as well? So if you're traded on that specific exchange, that's where the liquidity is and that's what everybody's buying. Obviously, that's what the factor. But for us, it's important that you have the New York Stock Exchange listing in the future, because that's going to create a larger pool of creation of the market for the company in the future.
Yeah, absolutely. That makes sense. Okay, so with the price environment where it is, and precious metals in particular here, we're talking, what are your thoughts on the M&A outlook? Do you see things picking up? And do you see that as a positive?
So yeah, I think M&A will pick up more, and the reason for that, I think these are going to be the crucial 2-3 quarters going forward. As we had a big uptick in the gold price, I think the balance sheet is going to be the key component to M&A. Who has a great cash flow positive balance sheet for these specific producers, and what's the growth trajectory beyond that for the next kind of, let's say, 3 to 5 or maybe 7 years, depends on the level of the company that wants to acquire. So we had one company that's been acquired in a specific region, and Colombia, just to disclose the country. And I think the reason they got acquired is because it was a mid-tier, well, more of a large producer that took over there from that perspective. Also, we've seen mergers happen between mid-tier producers between each other. I think that's also a key factor. And I think as the larger companies decide to start looking what's outside of their sort of in-house portfolio, what's out there that could add value, because now we're cash rich. The balance sheets are growing with more capital on the from the gold prices where they are now. So technically we have more to spend. But let's go back to early to 2010s, where the decisions were made poorly back then from acquisitions. I think this time around, shareholders are going to be pressuring more companies to carefully to acquire certain assets versus the other ones. We've seen one small disaster where they had to pause the acquisition. They paid a hefty premium, and because the asset is not even financially feasible to become even positive cash flow in the next 2 years, they just wrote it off for the time being and put on care and maintenance. So, and this was maybe 2 years ago acquisition. So I think acquisitions should pick up with those factors. It's just a matter of who wants more and who badly wants to sell it at what price. My only fear is that with the high gold prices, with the better balance sheets, or I think companies need to be realistic and not shooting for thinking gold be 3,000 and let's ask for much higher premiums. This is the last time we had this in 2010s, where gold was also around that price range. And a lot of the companies thought the sky was the limit, and it made a bad decision for not selling themselves early.
Yep. So smarter deals, smarter transactions, but potentially not as quick as the last cycle accelerated.
Correct.
Okay. Within your portfolio, then, would I be right in saying you're mostly precious metals, or are you entirely precious metals? And does this reflect of the family office capital, the family office New York mentality towards what they like within mining?
No, so we're flexible investors. Again, from us, it's we don't much invest in the copper space in the base metals. It's not that I don't have. It's been poorly performed over the years. The copper just recently got uptake, but we have a problem when a specific metal is bought or used by a specific country, where we don't think that price of a metal could be manipulated. Other ones as well can as well. Outside of precious metal, outside of, let's say, gold and silver, we like the lithium space. We have one investment as of the moment. I think with the depressed price in the lithium for so many, I guess for the last 2 or 3 years, it's going to be tougher to understand how that plays. We're looking at the diamond space again, so we do have experience in the diamonds quite well. They've been very depressed in the share price, and we like one particular company that will do very well once the pricing of diamond recovers. So we're looking for the sleepers, right? What's out there that's on, which is not favorable by the industry, right? Cobalt had a big sort of growth buzz, but nothing has really matured as much. Graphite, same thing. We avoid the trends. We avoid certain metals that are controlled by specific, again, country that's from production level or usage, as they're the only one that sit on that side of the table. But we are also looking for sleepers, right? But again, we're not going to go outside of our comfort zone if I have to be re-educated on the specific metal, and so on. Obviously, it's easier to find gold and silver assets. There's no shortage of that. Until there's no, I think in the future, until there's no favorable assets to invest because of those metals, then obviously you have to start looking outside of the scope. But we're never coming to that point. And we like royalty industry, right? So the royalty companies out there that are diversified, so less operational risk, zero operational risk, actually, from their business perspective. As long as the company's producing, they're collecting their NSRs and their royalties. So we like that space very well, and we're big believers. We have 2 positions in that space right now. But we're very opportunistic. But we like to look at the sleepers as well for the long-term view.
Yep, certainly. Okay, excellent. Just coming back to what you were saying about diamonds, actually, do you have any view as to when that the appetite or could come back for the diamond sector? Do you think this is something that's quite cyclical? Maybe it's been sort of the industry having to reinvent itself, certainly at the consumer end. What do you think some of the issues are there?
So there's two factors in the diamond space, kind of, or two, three factors how we look at the diamond space. So there's two major producers. There's De Beers and Olarosa, which controls 70 to 80% of the market, right? They're the leaders of production. One is the lead. Olarosa is the largest producer by tonnage, and De Beers is the largest producer by quality. I think about 33 million carats a year, plus minus. The diamond industry, the problem with the diamond industry is that there's never been a spot price. Right, we have all the Rappaport reports. We have other ways how to figure out what the spot price of diamonds. Now, there's been a lot of more loose diamonds out there. Now, that's been an issue of pricing method. There's oversupply than demand. Now, also, there's no new diamonds that have been there's no new productions in the diamond space where. The Divix right now, Diamond is looking to sell it rather earlier the other day. So there's no new production to facilitate those cheaper cost producers. Olarosa could produce for many more years. De Beers, with some of their assets, the same way. The smaller names, and this is a very small pool of another maybe 5, 7, 10 companies in the world, are hurting right now because of the depressed pricing and over the supply. Now, there's another factor, I'm sure you've probably heard, lab-grown diamonds, which is not a full substitute today yet, but it's becoming a more millennial, especially in the US, where diamonds are being bought by a certain crowd where they feel they should save and they believe it's more green focus. It's a sustainable product. So there is a pressure from multiple angles on diamond space. Now, if you have a collectible items or large pool, like one of the companies we used to be investors, they were producers and they had the large carats, like tennis ball type diamond, 1,000 carats, right? So I think those kind of companies will do well because they go to special auctions in Switzerland of the world and they get bought out pretty quickly. But on a large scale, I don't think diamond is going to get any better. The diamond industry is going to get better. The resale value of a diamond is getting worse and worse, and the competition rising from the lab-grown diamonds is also. And both industries are very volatile in terms of the pricing in general. So I don't see a full recovery for a while. I'm not sure. I still don't understand what needs to be done unless the consumers decide to start spending more money again on diamonds and pick up the loose supply that's left. But until then, there's no future of the diamond space for the next foreseeable 3 to 5 years. If somebody offered me to invest in a diamond company tomorrow from scratch, I would walk away and I tell them, get out of the business because you're not going to make any money. Unless you hit a specific kimberlite pipe that is such a high grade, you're very lucky. But that's a very few companies out there that have found or could continue to perform.
Yeah, certainly. Okay, so a long time strategy needed there. Just coming back to the overlaying pandemic, Michael, and I just wanted to find out, how has that affected your approach, or has it even impacted the way that you look at companies, meet companies, invest, that kind of thing? Obviously, travel restrictions are hurting deal flow for certain different capital providers, but what's the family office view to how you navigated operating in this environment?
I'll speak from a few ways. So from the public equities, because we do have such a long-term relationship with a lot of the C-levels, and to do quite a bit of these Zoom calls has been very efficient. And to get all the others, obviously going to visit the mine tours, that's obviously going to, prohibited today. And, unless you're looking at a new specific company, you want to check out the operations and so on. So I think that's been problematic. But overall, evaluating public companies or speaking to existing portfolio companies, we didn't have any issue. It was only understanding what was the protocols with COVID, what did you have to spend more money on, what did you have to create specific facility, what's the rotation of workers. So it's like the operational logistics side of it, which was to understand. And I would say 85% of them had very similar approach. So everybody was very efficient. If somebody got sick, they would rotate. They would actually rent out hotels nearby so their staff could live there. So they found a way, kind of create their own bubbles in a sense where they could have more efficiency. Now, from the private companies, that's a little bit challenging from around the industries that we invest, especially in the consumer space. We realized that that's going to be problematic because the way they operate, especially if they have to have whether it's warehouse or facilities, the travel, it put on hold a lot of the business, or orders got canceled. So from that perspective, we were very, we took a pause as well. And then from like a healthcare perspective, biotech companies have done tremendous during pandemic. Unfortunately, we could say it benefited some capacity because of the pandemic, but but some of them still going to be performed. But overall, it's still it's overall been not an issue. But yes, the travel kind of cut off, but business as usual. As long as the companies open the doors and they're working, we're fine. It seems like the miners have done just a perfect job over the course of the time.
Yep, absolutely. They have excellent and fantastic to hear that things are ticking over well on both sides. Michael, that's all I've got questions for, but thank you very much for giving us your time for one-to-one Money Investment Americas and having an insight into the family office approach from New York there. Thanks a lot, Mike.
Thank you, Adam. Thanks for having me.